Things are not always what they seem. The first appearance deceives many. That's Phaedrus, and it feels pretty perfect for our deep dive today. When we talk finance, most of us, our minds jump straight to the stock market. Maybe you're tracking the S&P 500 or, investing in some tech stock, maybe even following meme stocks. But what if that's just, well, the very visible tip of a much, much larger iceberg? What if there's this huge, intricate financial world operating just beneath the surface, often totally unseen? That's where the real power-shaping global finance might actually be. So our mission today, and we're drawing from a really insightful discussion published over in FE, is to sort of pull back that curtain. We're calling it the unseen power of offshore dollars and stablecoins. Look, for those of you preparing for exams, like UPSC, this is really crucial stuff. Daily current affairs for mains, maybe prelims too. For everyone else, it's just vital general knowledge to grasp what's driving global economic shifts. So yeah, if you're ready to get into the real financial plumbing, do hit that like button, subscribe, maybe drop your questions in the comments. Let's explore this together.
It's fascinating, isn't it? How much the headlines focus on just one part of the picture. You're absolutely right. The stock market gets all the attention. Just to put some numbers on it, the U.S. stock market, we're talking roughly, $32 trillion in capitalization?
Right.
And even India's market is significant, around $5 trillion. Huge numbers, obviously.
Yeah, $32 trillion sounds immense.
It does. But, and this is the key thing, it's really just one slice of a much, much bigger financial pie.
Okay, so you're saying even these massive numbers, they're kind of small fry in the grand scheme. Where are these other even bigger markets hiding? Why don't we hear about them as much?
Well, let's zoom out a bit. Beyond stocks, you've got these arenas where the scale is just, staggering. Take the U.S. bond market. That's valued around $55 trillion.
$55 trillion, okay.
And it trades something like $910 billion daily. Then there's the forex market, foreign exchange, where currencies trade globally. That's about $7 trillion, changing hands every single day.
$7 trillion a day.
A day? Yeah, even the housing market, estimates vary, maybe $50 to $100 trillion globally. And the mortgage-backed securities tied to that trade around $350 billion daily. But where the really big players operate, the institutions, the so-called big boys, that's often the U.S. swaps market. It's just enormous. Specifically, things like interest rate derivatives, IRDs. The outstanding notional value there was estimated around $258 trillion in 2024.
258 trillion.
Trillion, yeah. And within that, just interest rate swaps, IRS, account for a notional outstanding of about $469 trillion. Now, that's not actual cash changing hands. It's the underlying value these contracts are based on. But institutions use these markets for massive bets, for hedging huge risks. So they simply can't place bets that big in the stock market without, completely distorting the price.
Wow. Okay, so we're talking markets potentially hundreds of times bigger than stocks, operating almost out of sight for most people. This sounds like the real engine room. But how does this connect back? I mean, how does this hidden machinery actually affect someone just tracking their 401k or trying to figure out the economy? What's the practical link?
That's the million-dollar question, or maybe trillion-dollar, given the numbers. The connection, fundamentally, is interest rates. They're this unseen lever, influencing almost everything. Even if you're just a stock investor, understanding interest rates is critical. Think about how stocks are valued. A common method is discounted cash flow, DCF. You project future earnings, then discount them back to today's value.
Right, using a discount rate.
Exactly. And that discount rate is heavily influenced by current interest rates. If safe government bonds offer, say, a 4% risk-free return, then stocks, being riskier, need to promise a lot more to be attractive. So when interest rates rise, a few things happen. Companies pay more on their debt, leaving less for dividends or growth, which can push stock prices down. Plus, high inflation usually makes central banks raise rates, adding more pressure. And it hits consumers too, right? Higher rates on credit cards, mortgages. Less spending money means less demand, which isn't great for company profits or stock investments. Conversely, when rates are super low, you get that chase for yield. Money floods into all sorts of assets, pushing prices up everywhere.
So understanding things like yield, inverted yield curves, the spread everyone talks about, the 10-year versus the 2-year Treasury yield, even Treasury futures, which you mentioned trade, $774 billion notional daily on the CME. That's all really vital then.
Absolutely vital.
But who actually controls these rates? Is it all down to the Fed? Or are other forces pulling the strings?
That's a really important distinction. In the U.S., the Federal Reserve, the Fed, sets one key rate, the federal funds rate. That's the overnight lending rate between banks. It's the foundation. The Fed adjusts this rate based on inflation, growth, stability. You hear about them tightening or loosening monetary policy. But, and this is absolutely crucial for our deep dive today. The Fed directly sets only that one rate. All the other rates, mortgage rates, treasury yields, corporate bond rates, those are determined by the market.
Oh, okay.
And increasingly, these market rates aren't just driven by what's happening in the US, they're heavily influenced by global capital flows. And a huge chunk of that involves something called the Eurodollar system.
Right, the Eurodollars. This is where it gets really interesting, almost mysterious. You hear the term, but what exactly are Eurodollars? Why are they so influential, but so under the radar for most people?
It's a confusing name, isn't it? Because they have absolutely nothing to do with the euro currency. Zero.
Okay, good to know.
A Eurodollar is simply a US dollar that's held outside the United States. It could be in a bank in London, Tokyo, Singapore, or even an offshore branch of a US bank. The critical thing is, these dollars are not regulated by the Federal Reserve. They are not part of the official U.S. money supply figures you hear about.
Not regulated by the Fed. How did that happen?
It actually goes back to the Cold War, believe it or not. In the
Wow.
50s and 60s, the Soviet Union and other countries wanted to hold dollars, but they were worried about the U.S. government potentially freezing their assets if they kept them in U.S. banks.
Oh, okay. Makes sense.
So they started depositing their dollars in European banks, and those banks realized, hey, we can lend these dollars out. That was the beginning of this offshore dollar market. And over decades, it ballooned into this massive, sprawling network. We're talking wholesale money markets where banks, corporations, even governments borrow and lend U.S. dollars completely outside direct U.S. oversight. The scale today. Estimates put it in the tens of trillions of dollars. It's quite possibly larger than the entire U.S. domestic commercial banking system.
Larger than the U.S. banking system. Wow.
Yeah, and the implication is huge. Most of the world's dollar credit creation doesn't actually happen under the Fed's direct control. It happens offshore, in this parallel system. It's just as real, just as powerful, but way less visible. You could almost think of it like a dual monarchy for the dollar. The Fed controls base money and domestic banking. But this other monarch, the Eurodollar market, is decentralized, privately run, and it mints dollar credit offshore with minimal oversight.
How does it mint credit without the Fed?
Well, the Fed creates base money, like reserves. But in the Eurodollar system, banks create dollar claims through things like interbank lending, currency swaps, repo contracts, repurchase agreements. It's basically a web of promises backed by collateral and confidence. There aren't reserve requirements like in the U.S. system. And this can create a real disconnect. You might see the Fed pumping liquidity into the U.S. system, but global dollar markets could still be tight if confidence wavers offshore. Or the opposite, the Fed tightens, but ample Eurodollar liquidity keeps propping up risk assets globally.
So even if the Fed's hitting the brakes domestically, this huge offshore market might still have its foot on the gas, or vice versa. That sounds potentially chaotic.
It can be. It adds a whole layer of complexity.
And is that why the Eurodollar futures market, the one on the CME, is considered so important?
Yeah.
Because it reflects what this massive offshore system is thinking, maybe even before the Fed acts.
Precisely. That Eurodollar futures market is incredibly significant. It shows the market's expectation for short-term U.S. interest rates looking out up to 10 years. Banks, corporations, they use it heavily for hedging. But more than that, it often leads Fed policy. You'll see big moves in Eurodollar futures sometimes months before the Fed officially changes rates. It's the market's collective wisdom, or maybe fear, about where dollar funding costs are headed globally.
Not just what the Fed says, but what the market believes.
Exactly. And this system is also tangled up with the repo market, the overnight borrowing market. When things go wrong in the Eurodollar world, maybe a loss of confidence, maybe collateral issues, it can freeze up funding very quickly. Think back to the 2007 credit crunch starting, or that repo rate spike in 2019. Often the roots are in this less visible offshore plumbing.
Okay, so this really drives home the point. For you, our listener, whether you're that UPSC aspirant, an investor, or just trying to make sense of the economy, why is understanding this complex hidden plumbing so critical? What's the real-world impact?
The impacts are everywhere, direct and indirect. Think about emerging markets. Many borrow heavily in U.S. dollars. When this Eurodollar system tightens, or the dollar strengthens sharply perhaps because the Fed is hiking, suddenly those dollar debts become crushing for countries earning revenue in their local currency.
Right, we've seen that happen. Argentina, Turkey, Sri Lanka.
Exactly. Those crises often have roots in dollar funding stress. And then you get contagion. Scared global investors pull money out of anything risky, impacting markets everywhere. Your tech stocks might fall not just because of earnings, but because global liquidity is drying up. Remember the big market sell-off in 2022. Everyone talked about rising interest rates hitting tech valuations. True. But if you were watching Eurodollar markets, you saw signals of tightening, of dollar funding stress months earlier. It was a global liquidity squeeze playing out, the core lesson. You ignore interest rates and this offshore dollar system at your peril. Liquidity, especially global dollar liquidity, often drives returns far more than we realize, maybe even more than individual company performance sometimes. And the biggest engine for that liquidity, it's not in DC, it's offshore.
That's a really powerful takeaway. Liquidity is the main driver, often originating offshore. Okay, let's connect this to something newer but rapidly growing, stablecoins. How do these digital assets like Tether or USDC fit into this picture? Are they like a new digital form of Eurodollars?
That's actually a very insightful way to frame it. There are definitely strong parallels. Both Eurodollars and stablecoins aim to represent US dollars.
Okay.
Both operate largely outside the traditional US banking system and regulatory perimeter. They're essentially offshore dollar substitutes, enabling global access to dollar functionality. Neither is issued or directly backed by the US government. Neither falls under the Fed's direct oversight. So yes, they are both part of this broader shadow dollar system, helping the dollar maintain its global dominance, but operating in a sort of gray area.
Are there key differences, though?
Yes, definitely in their structure. A Eurodollar is basically an IOU from a bank, a promise by, say, a London bank to pay you US dollars. A stablecoin like Tether, USDT, or Circle's USDC is a digital token issued by a private company. That company promises it holds reserves, usually things like cash or short-term US treasuries, supposedly backing each token one-to-one. So one is a bank liability, the other is a claim on a private company's reserves. But in both cases, the value ultimately relies on trust in the issuer.
Trust that they can actually pay you back in real dollars if needed.
Precisely. Neither is a physical dollar in a Fed-supervised vault accessible to you. They are dollar claims operating outside the core system.
So whether it's banks lending Eurodollars in London or a crypto trader using USDT in Singapore, they're using these synthetic dollars or dollar claims that behave like money but aren't directly Fed created or guaranteed. And these systems influence everything: stocks, crypto, debt.
Absolutely. These off-grid dollar systems, both the older Eurodollar market and the newer stablecoin ecosystem, have profound impacts. They affect stock prices through liquidity flows, they fuel crypto volatility, they're deeply intertwined with emerging market debt, they influence the dollar's exchange rate, and they impact liquidity conditions even for traditional banks globally. They live in this fascinating, slightly dangerous space between being incredibly useful tools for global commerce and potential sources of systemic risk if that trust falters. Look at Circle, the issuer of the USDC stablecoin. There was that example mentioned in FE. Its stock debuted, shot up incredibly fast after the Genius Act, a proposed U.S. regulation bill, passed a hurdle, became a $50 billion company almost overnight.
$50 billion just for issuing a stablecoin.
Well, the market potential is seen as enormous. Citigroup thinks the stablecoin market could hit $3.7 trillion by 2030. Standard Chartered sees $2 trillion in just 3 years. The business model is simple. They take your dollars, issue tokens, and invest the dollars, often in safe things like short-term treasuries currently yielding maybe 5%. They profit from the float.
Right. Using someone else's money to make money.
Essentially, yeah.
Yeah.
And for users, especially in countries with high inflation, like Zimbabwe, for example, holding a USD stablecoin can be a lifeline, a way to preserve value when their local currency is collapsing. It's a direct dollar substitute for them.
This has been a really eye-opening journey. We started with the familiar stock market, then dove way deeper into interest rates, the massive Eurodollar system, and now this evolving world of stablecoins. It's clear the dollar is way more complex than just green pieces of paper from the Fed. It's this intricate web of offshore promises and digital tokens, too.
It really is. And I think the key thing, especially for listeners maybe studying these topics or just trying to navigate the world, is that understanding this plumbing, this ghost in the machine, isn't just academic. It gives you an edge. Recognizing how liquidity, especially offshore dollar liquidity, really moves markets, sometimes more than headlines or earnings, helps you see the financial world differently. It helps you prepare for, maybe even survive, the next inevitable storm.
A definite edge. It makes you think differently about risk and opportunity. So a final thought for you, our listener, to ponder. In this world filled with financial noise, what other unseen forces might be shaping our economic future? And how can your deeper understanding, digging into topics like this, help you better navigate whatever comes next? Keep exploring, keep connecting the dots, maybe link this to other current affairs for your UPSC prep or just general curiosity. And please do hit like, subscribe if you haven't, and share your thoughts or questions in the comments. We really appreciate the engagement and look forward to the next deep dive.